Good afternoon. My name is Milam Newby, and I'm a partner in Vini's Austin office, where I focus on M&A, private equity, and venture capital transactions in the technology space. I'm also the firm-wide head of our technology practice. On behalf of everyone at Vini, welcome to today's presentation on equity and executive compensation issues for technology companies. Now, please join me in welcoming Shane Tucker and Matt Green. Shane and Matt both practice in our executive compensation and benefits groups, where they advise employers, executives, and management teams on the tax and securities law implications of compensatory arrangements. It's my pleasure to now turn the presentation over to Shane and Matt.
Thank you very much, Milam, and thank you everyone for joining us today. Just to go over kind of what today's agenda will be, we kind of thought what might be helpful is to walk through the different types of equity awards that might be available. I know looking at the RSVP list, although technology companies are frequently more focused on C corporation equity arrangements, we do have kind of a mix of attendees, and so we'll also be talking about profits interest as well, which would really be applicable to the extent you have either a pass-through structure or a fund structure. We're also going to talk about incentive plan design considerations and corporate formalities. Because we're going to touch on partnership compensation, we're also going to discuss partner employee issues. And then we're going to round out the presentation with some Section 409A deferred compensation issues that frequently impact technology companies and the types of incentive and equity arrangements that those companies provide. We'll turn it over to Matt to get us started.
Okay, great. So we're going to start off first talking about the forms of equity awards and kind of the initial question, which those listening may not have complete control over, is what kind of entity is going to be granting those equity awards? As Shane alluded to, whether that's a C corporation, a pass-through entity, a partnership, certain forms of equity awards that we're going to be discussing today can be implemented, at either of these types of tax structures. However, certain forms also lend themselves better to these equity types, whether that's profits interest in the partnership context, than restricted stock or ISOs in the corporation context. So here on this chart, you'll see that there are kind of two main categories of awards, both appreciation awards and full value awards. Appreciation awards just means that the value you only realize any value if the company's value increases after the date of grant of the award. And full value is you have value on the day of grant. In addition to those two categories, we have both real equity and phantom equity awards, meaning that the awards are settled in actual stock or units or other equity interests of the company, or they're settled in cash or some other consideration. So we'll go through each of these in depth, both starting in the real equity appreciation awards. Both we have stock appreciation rights and stock options, both the non-qualified and incentive stock options, or what are also known as statutory stock options. Under full value, we have restricted stock and restricted stock units, or RSUs. Then phantom equity, we've got the cash settle of both profit interest and SARs, then phantom stock and performance units. So starting off with incentive stock options, also known as statutory stock options, the IRS has provided special tax treatment for these incentive stock options, provided that they meet the requirements of Section 422 of the Internal Revenue Code. Note that these can only be granted to common law employees of either the granting corporation or a parent or subsidiary corporation. So you'll want to go through that analysis before you actually grant any of these awards. And then finally, as discussed when we were talking about the entity forms, only corporations can issue incentive stock options, unless, of course, the LLC, your company, elects to be taxed as a corporation. Any options that are not incentive stock options will be non-qualified stock options, which we'll discuss. And incentive stock options are generally not subject to Section 409A, and we'll get into a further discussion of that later on in the presentation. Okay, so for the requirements for an incentive stock option, you'll note the first one is that it has to be granted pursuant to a shareholder-approved written plan, and that plan has to state the maximum number of shares that can be granted with respect to ISOs. So a lot of times, if you have a stock option plan or a long-term incentive plan currently, you can look at the provisions that discuss how many shares are being reserved, and you'll see some language also reserving a certain number for the issuance of incentive stock options. Note that they can't be exercised more than 3 months after the employment ends, and the exercise price generally has to be at least equal to the fair market value of the stock on the date of grant. You'll see below that there are additional restrictions for 10% owners, so you'll need to do an analysis of the ownership of the recipient prior to granting these. The term of both the plan and the incentive stock option can't exceed 10 years, or in the case of 10% owners, 5 years. They're non-transferable. And then you'll want to make sure you keep good notes because with respect to this next bullet, the rules require that the aggregate fair market value of the stock when it becomes first exercisable, so when it vests in a calendar year, cannot exceed 100,000 under all plans. If it does exceed 100,000, then that portion will be treated as a non-qualified stock option. So if you have a employee who has multiple outstanding options, you'll want to make sure that you're tracking that, and that 12-month, that calendar year is also a 12-month rolling period. So when you do this analysis, make sure you're incorporating all the options that have vested within that 12 months.
To add one point on the 3-month exercise period, we're going to talk a little bit later about modifications to options. Frequently, you might have a situation where someone terminates employment and you want to give them some extra time to exercise their options. And so you extend that exercise period to a year, 2 years, or maybe even to the end of the underlying term of the option, that initial 7 or 10-year term. If you do that, as soon as you make that amendment, that incentive stock option will become a non-qualified stock option. So that's something to be aware of. There's really nothing to do to fix that, because just by definition, an ISO has to be exercised within 3 months following termination of employment. But you should just be aware, if you think an individual might exercise in that 90-day period in order to receive the incentive stock option treatment, any extension of that will, at the time of the extension, cause the incentive stock option to become non-qualified.
Okay, so if you've met these requirements, this is the favorable tax treatment that they'll receive. So both upon grant and exercise, the employee is not going to recognize any taxable income. Note, however, that at exercise, the spread is an alternative minimum tax adjustment, and so you may have some tax on that depending on whether the employee has to pay the alternative minimum tax or not. These ISOs are exempt from employment taxes and withholding. And then the basis is based on the amount paid on the exercise of the ISO. And then finally, subject to both selling after 2 years of the grant date and 1 year after exercise, the sale of the stock received upon exercise will be subject to long-term capital gains tax.
And to add a little bit of color to that employment tax exemption, that employment tax exemption may be helpful in connection with a transaction where somebody's coming in and maybe buying the company for cash. You can save on the FICA hit with regard to the exercise of all of those options. However, in order to receive that treatment, you actually have to exercise the options. So if the merger agreement, for example, says, or the purchase agreement says that the incentive stock options are going to be purchased in cash at spread, that will actually be subject to withholding. In order to exempt those options from withholding, you would actually have to go through the process of having the options exercised, stock issued, which can be done on the same day, but you would have to have a real issuance of stock, and then you would sell the stock in the transaction. That would still be a disqualifying disposition, because you did not hold on to those shares for the holding period that's in that last bullet there. But you would still save on the employment taxes because you exercised an ISO. So I talked briefly a couple slides ago about extending the exercise period when somebody terminates employment. That's a modification, and one of the ways that you potentially lose ISO status is if you modify, extend, or renew an ISO, because that's treated as a re-grant of an option. This concept on modifications also becomes important with respect to 409A, which is probably more important. It's one thing to lose ISO treatment and to convert something into a non-qualified option, but if your modification causes an option to be converted into an award that is subject to an additional 20% tax, that's obviously much more problematic. So a modification means any change in the terms of the option that gives the optionee additional benefits under the option, regardless of whether the optionee in fact benefits from the change in terms. There are two specific exemptions provided in the Treasury regulations. Accelerating the time of exercise is not a modification. So if you mess around with vesting, that actually doesn't create a modification. And it's not a modification for the company to exercise discretion that's been reserved under an option, with respect to bonus payments at the time of exercise, the availability of a loan at exercise, the right to tender previously acquired stock purchasable under the option, or the payment of employment taxes and our required tax withholdings from the exercise of an ISO. It actually is problematic to add a net settlement feature to an ISO, although that's not a problem in the 409A context. And so the 409A rules are slightly more flexible than the ISO rules, although the 409A rules refer you to the ISO regulations, and so they are very, very similar. Now, as I said previously, any post-termination extension is going to be considered a modification, and you'll immediately lose ISO status. Although, as we'll talk about later, there are some exceptions to the 409A rules that allow you to do that. All right, moving on to non-qualified stock options. So a non-qualified stock option is just an option that doesn't satisfy the requirements to be an ISO. So you're one or the other. If you don't in order to be an ISO, you actually have to state in the award agreement that you intend the award to be an ISO. But even if you say that, if you don't comply with any of the with all of the requirements of an ISO, then you automatically have a non-qualified stock option. The way we typically draft our awards, we actually generally say, if it's intended to be an ISO, this award is intended to be an ISO, unless it does not comply with the ISO rules, in which case it'll be treated as a non-qualified option, so that you don't have to kind of grant two separate awards, the award that you think is going to be an ISO and the award that you don't intend to be an ISO. You just grant one, and you just kind of have to track it. That in particular, that would be an issue with regard to the $100,000 limit on ISOs. If you're granting awards to C-suite executives, you may very well exceed that number. It can still be treated as an ISO up to the limit, and thereafter the option will be treated as a non-qualified option. You're just going to need to track that internally so that you can ensure when the option is exercised, you're going to have to withhold on a portion of that option to the extent it's both an ISO and a non-qualified option. So with non-qualified options, you have a lot more flexibility because you don't have to comply with the ISO regulations in Section 422. and one of those flexibilities is that you can grant to directors and consultants and independent contractors who are not employees. There's no statutory limit on when the option must be exercised following termination of employment. If we didn't have to comply with 409A, you could issue at a discount. You still actually can issue a non-qualified option at a discount. It's just going to be subject to 409A. It's not going to be exempt from 409A. And so you're going to have to ensure that it's only exercisable. You're going to have to ensure that either you have to exercise that option when it becomes vested, or it's only going to be exercisable on the 409A compliant events, which really limits the exercisability. So discounted options are still pretty less common just because of the 409A limitations there. So like ISOs, with a stock option, there's no income recognition upon grant. There is a small exception in the regulations that says if you have a readily ascertainable fair market value on that option, that really that's typically where if an option is traded on an options market. So you're very, very rarely going to see that. So when you grant an option, you don't get taxed on grant. You do get taxed, though, under a non-qualified option at exercise, and you're taxed on the difference between the fair market value of the underlying shares at exercise and the exercise price. That spread is ordinary income, and it's going to be subject to withholding and employment taxes. One of the things we're going to be talking about with respect to equity compensation generally is what most employees would like to see with regard to their equity compensation. And that's this sort of holy grail of obtaining equity for the performance of services, but also getting capital gains treatment with regard to that equity award. And really, that's kind of an on-off switch, as you'll kind of see in all of these awards. If you give someone value, if you give an employee or a service provider value, that value is going to be taxed at ordinary income rates until the equity has become vested and the individual is now kind of functioning as a passive investor. Because the way the rules generally work is, with regard to full value awards, vesting indicates the service period. So you get taxed at vesting to take the comp element off the table, and thereafter you're now holding a capital asset, and any additional appreciation is capital gains. With options, all of that spread prior to exercise is ordinary income. And so once you get to the time that you exercise, you close that compensatory element of the award. Now you hold a capital asset. All additional appreciation is capital gains. Where the question I'm most frequently asked is, okay, well, how do I just get capital gains? And there are actually a couple of awards that try to do that attempt to do that, although you'll see it's kind of imperfect. But one way of thinking about that is exercising stock options with a note. And what you would do in that case is you would grant an award, and let's say your fair market value is $1 a share. You grant someone an award that's exercisable for $1 a share. And let's say the guy has 1,000 shares. You would give him a note for $1,000 so that he could exercise immediately. So this would be an early exercise option that allows the individual to buy restricted stock, and the restricted stock has the same vesting schedule as your option would be. So if you had an option that was vested 20% per year over 5 years, you would give someone, and you wanted to allow them to exercise with a note, you would give them an early exercisable option. They would pay the exercise price with a note, and then they would receive restricted stock that has the same vesting schedule, 20% per year. So if they leave 5 days after they exercise, they're still going to lose 100% of that option. If they leave between a year and 2 years, they'll lose 20%, and so on and so forth. What happens when you do that is you close the comp element, even though this option is still subject to vesting. And you close the comp element by doing a Section 83B election at the time of exercise. But that 83B election, normally, if you gave someone restricted stock that was worth $1 a share and they did an 83B election, you'd be taxed on $1 per share. However, because you used a note to actually purchase the exercise price, you haven't received any compensation. The employee hasn't received any compensation. And they paid $1 to exercise stock worth $1, to exercise an option with underlying shares worth $1. So there's no spread on that option. And when you do the 83B election, you do an 83B election for $0. So you take no income into account. Then what you would eventually do is you would sell the stock, and let's say you sell the stock at year 7, and that $1,000 option is worth $3,000. You now have a capital asset. You have $2,000 of capital gains over the basis of the shares that you bought for $1,000. However, you would have to at that point pay off the loan. So you would sell the shares for $3,000. You would pay off the $1,000 of principal plus any interest, and the remainder you would hold at capital gains rates. So that's going to be a pretty significant tax savings even after paying the interest. And that is a way to sort of create an instrument that gives you spread and receive capital gains. Now, the downside of this arrangement is that the employee actually owes the company money under the note, and the note has to have terms that will be respected by the IRS. It can't be a fake loan. It can't be a loan that has features that would be I don't want to say uncommon in the market, because it is an employee loan, and so there may be some employee favorable features. For example, it may require repayment at termination of employment or something like that. But what you don't want to have is features, for example, that embed forgiveness in the note, or that would otherwise make the note not be respected for purposes of the IRS's rules in this regard. The other point about that is if you do forgive the note, let's say you don't specify that you're going to forgive the note, but at termination of employment, the company elects to forgive the note, that will result in ordinary income. You're going to have ordinary income on any amount of forgiveness. That becomes it becomes problematic in any kind of downside scenario. So if the shares lose money and you and the company forgives the note, you're still going to have income on the note because it was forgiven, and you're not going to have sufficient stock value to cover that note. That's also problematic because in order for this structure to work, that note has to be partially recourse to the employee. The amount of recourse will depend it's going to depend on your accountants. I think practitioners are generally willing to go down to 30%. There is IRS guidance that that 30% is defensible, 25% is defensible, but usually we go at 30%. But some accountants actually want you to be at 50%. So whether or not this is a feature that is going to kind of work for you, it's important to sort of think through how onerous is the downside scenario going to be, how much recourse are our accountants going to require to kind of decide whether or not this would be helpful or interesting.
Okay, so now we're going to move on to restricted stock. And what restricted stock is are just shares of the company's stock subject to certain restrictions, both on transferability, and then also there's a substantial risk of forfeiture. The restricted stock can include various vesting provisions. In the example that Shane gave, where you early exercised and you got restricted stock, those were still subject to the underlying vesting. Same here, you can grant restricted stock and put vesting provisions on it, but it is actual ownership on the date of grant. As Shane discussed 83B elections, for restricted stock, you can make an 83B election, and that means that on the date of grant, you realize into income, taxed at ordinary income, the fair market value of the stock. And then once a vesting event occurs, let's say it vests 1 year later, there is no subsequent taxation there. It's only taxed when you actually sell the stock, and that receives capital gains treatment. So long as you hold the stock, I will note that the holding period begins when you make the 83B election on the date of grant. And so after you sell it, you should generally get long-term capital gains tax because you've held it for longer than a year. If no 83B election is made, then no tax is recognized at grant, and instead you're taxed at vesting. And that taxation is generally the excess of the fair market value of the stock at vesting over the amount paid. You don't really, for the most part in equity awards, you're not really paying for the grant of restricted stock. So it really will just end up being the fair market value of the stock on the date of vesting. And you take that into ordinary income in the year of vesting. The company is entitled to a deduction at the same time the grantee realizes ordinary income. So if an 83B election was made, the company gets that deduction on that date of grant in that year. And if it was not made, it gets it every time that vesting occurred. And then finally, it is also subject to employment taxes and withholding for federal or state income taxes.
I also add, even though you have granted restricted stock and the individual is an owner of the restricted stock, for tax purposes, the employer is actually still treated as the owner until vesting occurs. So that has a couple of different implications. Matt kind of alluded to this. Your capital gains holding period, if you don't do an 83B election, your capital gains holding period doesn't start until you actually vest. And in addition to that, while the shares are unvested, to the extent you haven't done an 83B election, any dividends or distributions paid with respect to that stock are ordinary income. They don't count as distributions. They are dividends for kind of purposes of this guy's a shareholder and he's entitled to dividends. But you'll actually have to run those dividends through payroll, and they'll be subject to withholding and employment taxes, and they're really just kind of treated as an additional bonus until vesting occurs, assuming you didn't do an 83B election.
The next type of award is stock appreciation rights, and these can be either stock or cash settled. This just provides the right to receive company stock or cash in amount equal to the appreciation in the stock from the date of grant to the time of settlement. You might be wondering what kind of is the main difference between a SAR and an option, because they both kind of realize the same value, that appreciation. The main difference is that, if they are stock settled, you don't generally have to pay an exercise price when they are settled for the stock appreciation rights, whereas under an option you would. And if they are settled in stock, you get actual ownership at settlement. Like an option, no income recognition at grant. Then at settlement, you're taxed on the spread, the fair market value of the amount received over the strike price or the exercise price. And finally, employment taxes and withholdings do apply. Note that the company will get a corresponding deduction equal to the amount of depreciation, the spread at settlement.
So one of the limitations on restricted stock is the inflexibility in timing the taxation of those awards. So as Matt mentioned, if you do an 83B election, you're taxed up front. You can obviously control that, but you have a bunch of tax up front at a time where you probably don't have liquidity. Plus, and on top of that, you've taken into income an amount of income on an award that is potentially forfeitable. So you could have been taxed on something that you actually don't get to keep. If you don't do an 83B election, you're taxed immediately upon the vesting event. So particularly if you're a private company and you've got an award that's vesting over 5 years, annually, you're going to have to come up with liquidity to cover the taxes associated with that vesting event. And you have an illiquid security, and you may not have liquidity at the company in order to sort of front those taxes. And you may have employees who don't really want to front those taxes. That's probably, this is one of the main reasons that with private C corporations, we most frequently see options, because options allow you to defer taxes to liquidity or potential liquidity. And while everything is ordinary income, at least you don't have to worry about coming up with tax withholding on an illiquid security at a time prior to the ability to sell that security. Restricted stock units and phantom units allow you a great deal more flexibility in the timing of a full value award. So unlike restricted stock, where you only have the choice of being taxed upfront or upon the date of vesting, for restricted stock units, you can defer the timing of the payment. So what these phantom awards do is they represent contractual rights to receive cash payments or shares or units equal to the value of a certain number of shares at a specific time or upon a specified event in the future. There's no tax on grant, but upon settlement, it's subject to ordinary income tax, whether you pay out in cash or in units. Any dividends received are taxable as ordinary income, and that's true for the entire life of the award. Even after vesting, a phantom award, the dividends are always just going to be treated like a bonus, and the company is going to be entitled to a corresponding deduction at the time the individual, is the employee or the service provider, is subject to taxation. These awards, however, are going to be subject to 409A to the extent, well, they are going to be subject to 409A. You can either be exempt from 409A, in which case you would say, as soon as I vest, I'm going to pay these out. But then you run into the problem that we have with restricted stock, where you have a withholding event when that does not correspond with liquidity. So you can push out that settlement event beyond the vesting date. That will get you into Section 409A. So at that point, the difficulty lies in creating a payment event that is 409A compliant or exempt from 409A, that is also corresponding to what the company would view as a liquidity event. Under 409A, for example, amounts that a company might consider to be liquidity events, financing, a sale of a minority interest when bringing in a new investor, an IPO, those are not going to be 409A payment events. The 5 events that can trigger that are allowed to trigger payment under 409A are: 1, a fixed date that is selected kind of upfront at the time of grant; 2, death; 3, disability as defined in 409A; 4, a separation from employment, a separation from service; 5, an unforeseeable emergency; or 6, a change in control. And a change in control under 409A is truly a change in control. Somebody comes in and takes control of the company. You bring in an owner that comes over 50%. There's also lower thresholds that can happen within a 12-month period, and there's also an asset sale threshold. But with 409A, what you want to think about is not, I sold 30% of the company at market at an IPO to a diverse set of investors, but I actually sold a significant portion of the company to another person. So that's why IPOs don't trigger a payment event under 409A. One last point with regard to restricted stock units or phantom units: you can't make an 83B election with respect to those awards. Okay, now just to touch on profits interests. Profits interests are a special class of membership interests in a partnership, designed in a manner to entitle the holder to a share in the partnership's future profits, but no share in the partnership's asset values as of the date the award is granted. So the way you think about a profits interest is, think about it like an option. And when you grant a profits interest to an individual, you need to be able to say the tax test is: if we sold all of the assets of the company at fair market value and ran the proceeds through the waterfall, would you, person who's receiving a profits interest, be entitled to a distribution? If the answer is no, it's a profits interest. If the answer is yes, it's not a profits interest. And the nice thing about a profits interest is that it's not taxed at grant or at vesting. So it's essentially an option that is never taxed, that does not have an ordinary income component. It's never taxed at ordinary income rates. You are simply taxed as a partner. That's actually true whether or not you do an 83B election. We typically, not typically, we recommend that people do 83B elections on profits interest, but they're really a protective election, because even if the award is subject to vesting, if it was properly structured, if it's not in the money on the date of grant, then there is no compensatory element to the taxation associated with that award. You're still going to be taxed as a partner, so you're going to get your pass-through amount of income, and that's going to retain the character of whatever the income is. So if the partnership is generating ordinary income, you will have ordinary income, but you're going to have ordinary income as partner. You're not going to have ordinary income as an employee. Now, because there is not an ordinary income element to these awards, the partnership is not going to be entitled to a deduction. There are also potential employee partner issues that we'll talk about a little later. But the profits interest, again, similar to the exercise of an option with a note, is a special vehicle whereby an employee can participate in the appreciation of a business without having a note, without having to ever pay an exercise price. And if the partnership doesn't generate any ordinary income, and the eventual liquidity event is a sale of the partnership that just passes through capital gain associated with the sale of the underlying assets or the sale of the underlying entities, that's going to be that will be what's effectively a compensatory vehicle that was entirely taxed on all appreciation and capital gains rates. And that's really only available in a pass-through structure. It's only available with respect to profits interest, and it's really based on a special IRS rule. It's actually not even in the regulations, where the IRS said, as long as the award you received is not in the money when you receive it, as long as it is not tied to a readily determinable stream of income. So, for example, you can't put a profits interest on like a bunch of high grade debt where you're going to have a bunch of distributions going through. That doesn't work. And as long as you don't dispose of the property within 2 years after grant, it's going to get this special treatment. But although I will say, even if you dispose of the interest within a 2-year period, let's say you dispose of it within a year and 2 years, that simply means you're no longer in the safe harbor. And so that kind of opens up a conversation with your counsel and your accountants as to whether you could still treat this as a non-compensatory profits interest.
Okay, great. So now we're going to move on to incentive plan design considerations and corporate formalities. Things to be thinking about if you're in charge of granting these awards, if you're thinking about putting in place a plan. We'll discuss those now. So the first thing is incentive plan design considerations. You'll want to think about how many shares you want to reserve under the plan, or the allocation of cash that you want to distribute via equity awards to your equity, or awards that settle in cash to your employees or service providers. Particularly with the amount of shares you reserve, this is going to have a dilutive effect on your existing shareholders. And so a lot of times, whether you're in the early stage or whether you're a public company who's seeking to approve a new plan, the percentage of your shares reserved is going to be a key point of consideration. Once you kind of determine that, you'll want to think through the various vesting terms that you want to place on these awards, time and performance. For example, time, we've kind of alluded to various vesting schedules. You want your employee or your service provider to continue providing services to you, and so you can restrict the vesting of the equity awards to vest annually over 3 years or so forth. And so in order to realize the full value of the award, the employee or service provider has to continue with the company. For performance based metrics. You can use any type of performance metric, maybe some, financial or accounting metrics that you track internally as a company, whether that's, increases to EBITDA, revenues, profit, net profit, as well as if you are a public company or when you become a public company, the performance of your stock price on the market. Treatment on change in control or treatment on IPO. Things to consider here are whether or not you want to accelerate the vesting on these types of events. And specifically, a lot of times, especially in the change in control context, you can have awards that vest on the date of the change in control, or you can have awards that are essentially double trigger, meaning you have to go through a termination and the change in control has to occur in order for those to fully vest. Finally, for leaver provisions, when you think about employees terminating their service and how the company characterizes that termination, could provide for various acceleration of vesting, whether that's a prorated vesting because they've been terminated without cause, or if it's if they've been terminated for cause, you'll want to think about whether they should forfeit the awards they have, and if they're entitled to keep awards on either type of termination, whether or not the company wants to buy back, repurchase those awards. The problem you'll have is, especially for a private company, an employee leaves. You don't really want them to realize the value, the increased value, since they've been gone and they hold, a vested stock or unit in the company. And so these repurchase provisions would provide the company the ability to purchase those back.
I would note just briefly, if you're a public company, single trigger vesting upon a change of control is going to be frowned on by institutional shareholders unless the buyer in that transaction refuses to assume awards. So that increasingly in the market, you're seeing elimination of those single trigger awards in favor of double trigger.
And the other two kind of considerations you want to think about are tax considerations and then various law considerations, including U.S. securities law and then also state law considerations. We've discussed, ordinary income versus capital gains, the various deductions companies can take, then Section 83B elections, and we will go into some Section 409A stuff. For securities laws, for private companies particularly, you want to make sure that your equity award grants are exempt from those securities laws, and a lot of companies will take advantage of Rule 701, which comes with various requirements and limitations. If they don't use that, maybe they're only granting to accredited investors, but you'll want to enlist your counsel to make sure that there aren't any disclosure requirements around whichever exemption you're choosing to use. Then for blue sky laws, something to consider is where these recipients live. A lot of times, the blue sky laws are just state securities regulations, and a lot of times the U.S. security regulations will supersede those. But specifically, you want to pay attention to where they live. Two states to consider are both California and New York, but enlist your counsel to kind of run through any of those hiccups that may occur. For best practices for granting awards and administration, just think about, properly documenting the grants that you're making, who's granting the awards, whether it's the board, the committee. If you want to delegate that authority to the CEO, make sure that you have resolutions that show that delegation. When determining fair market value, to make sure we're compliant with Section 409A, you want to state the exercise price and determine what that fair market value is and what the company relied on for that valuation, as well as approve equity award agreements. And then finally, just keep track of your outstanding awards. This is really important, especially when they vest. They're going to move from your equity awards schedule to your cap table. And there are various platforms out there to use, but just be cognizant of that. And that whoever's in charge of that is keeping a good record.
And I would stress a little bit the delegation issue. That's something that we kind of most frequently run into with clients where where a CEO or other executive officer has been delegated the ability to grant awards to new hires because that's obviously a lot easier than going to the board or the committee every time a new hire comes on. But you really do want to make sure that you've properly delegated that and that you've papered it so that it's so that on, for example, an acquisition, when the buyer is doing that diligence, there aren't any questions as to whether the awards have been properly approved. Now we're going to move on to employee partner issues. Okay, so where this arises is a situation where a management member holds partnership interests and is employed by the same entity. So if you just imagine a partnership and you grant management profits interests in that partnership, but you're also running payroll out of that same entity, and all of those management members are employed in that partnership, that creates an employee partner problem because you are taking the position, these are my employees, but you have made them partners in that same entity, or you have a disregarded entity below. I'm sorry, you have a disregarded entity below. So this LLC is 100% owner in this LLC, and the employees are down here, and you give them equity up here. It's still the same problem. They are partners in the same entity that are in the same entity structure because these are disregarded, and they're both employees and partners. What the IRS says is if you're an employee and a partner, you're just a partner. You're not an employee. Payments to a dual status partner employee that would otherwise be treated as wages subject to withholding and reported on W-2 are instead going to be treated as guaranteed payments on a K-1. You're not going to actually report anything on W-2 because you're going to treat those individuals as self-employed. They're not going to be subject to withholding. They're going to have to make quarterly estimates to the IRS. They're going to pay their own FICA, and they're not going to be eligible to participate in certain tax advantage benefit plans, cafeteria plans that would allow them to make pre-tax payments for medical coverage, for example, although there is currently still an above the line deduction for that for a self-employed individual. Flexible spending accounts are something they won't be able to participate in. That doesn't seem like the end of the world, but you do want to make sure if you have this issue that your plans are structured properly so that self-employed individuals are even eligible to participate in those plans. But recently, the IRS has also started to suggest that, at least in one case, they've suggested that at exit, all of the appreciation received in a transaction should be a guaranteed payment instead of taxed as a pass-through partner. That's all compensatory rather than capital gains, for example. So that kind of raises the stakes a little bit with respect to employee partner issues, and so it's something that I would recommend that if you have it, you fix it. There's three ways to fix. Well, there's multiple ways to fix, but here are three common structures to avoid the employee partner problem. Really, the only thing you're doing, it's a form over substance problem. It's a form over substance solution. You just want to create a regarded entity between the employing entity and the entity in which the individuals hold equity. So in this first alternative, you have this management aggregator that is owning in the entity with the private equity fund, and so that actually creates multiple partners in the portfolio company. The employees are employed at the portfolio company, and management is actually holding through the aggregator structure. That avoids the employee partner problem. In alternative two, you have what's commonly referred to as a sliver blocker. What you've done, you can imagine before this member LLC entity off to the right is inserted, you have a portfolio company and an operating company. Normally that would create a problem because if you go up for the management LLC is 100% owned by portfolio company LLC, and management owns in portfolio company LLC. So there's an employee partner problem, but you cause management LLC to become regarded by putting in a sliver blocker there. That's member LLC. So you have a corporation that owns some small percentage. In this example, we've used 0.01% That does mean you're going to have a little bit of tax drag because any amounts that are kind of run through management LLC are going to get taxed in member LLC. Now, kind of in this structure, what you would end up doing is from the operating company, you would end up actually moving money into management LLC in order to pay comp, and you would mark that up a little bit, and that's where you're going to have tax drag through member LLC. The final the final alternative is very similar to two. It's just the operating company sits down below, but it's the same issue. You've created a sliver blocker, and therefore you've avoided the employee partner problem. All right, we're going to move on to Section 409A issues. So Section 409A applies to all non-qualified deferred compensation plans that aren't otherwise exempt. A deferral of compensation exists if, under the relevant facts and circumstances, a participant has a legally binding right during a taxable year to compensation that is or may be payable in a later tax year. Now, you've probably seen in a lot of your agreements, be they bonus agreements or other agreements that provide for annualized payments, they will say the payment will be made by March 15th of the year following the year in which it's earned. Or you might see, or an agreement might say an employee has to be employed on the date of payment. Both of those are an attempt to avoid 409A, to be exempt from 409A, because there is no deferral in that circumstance. As long as you pay before March 15th of the next year, that's actually not deemed to be pushing comp and potentially pushing comp into a future year. And if you have that date in there, or if you say if an employee is not employed on the date of payment, he doesn't get paid, no deferral has occurred, because the employee did not have a vested right to compensation in 1 year that he can quit and still keep in a future year. So this definition is very, very broad. It includes voluntary employee paid deferred compensation, like a salary deferral, which clearly looks like deferred comp. But it also includes employer paid deferred compensation. If you tell someone you're vested in this right, we're going to pay it to you in 3 years, that's deferred compensation. Other obvious examples are like retirement plans that are designed to be deferred compensation. But options and stock appreciation rights that are granted at less than fair market value, or that are granted that are not granted properly with the proper service recipient stock, those are also subject to it. As I said, RSUs, phantom arrangements are subject to 409A. Severance, retention, and change control arrangements are all potentially subject to 409A, and international compensation plans with U.S. taxpayer participants can also be subject to 409A. The failure to comply with 409A results in an additional 20% tax to the individual, plus early inclusion of income. So to the extent that you haven't been taxed on an amount, as soon as you become vested in the amount, you are going to be taxed even if it hasn't been paid, plus 20%, plus an additional 20% tax. There's also penalty interest based on the IRS underpayment rate, because the idea here is you should have paid taxes on these deferrals and you didn't. And the tax liability is imposed on the service provider, not on the employer. 409A is intended as a revenue raiser, and it hits the employee to kind of incentivize employees not to be aggressive with these arrangements. The employer does have income tax withholding and reporting obligations, and may be subject to penalties for failure to properly withhold and report the taxes, although you don't have to withhold on the actual 20% additional tax.
Okay, so something that comes up and we've alluded to throughout this presentation is that the stock options and the SARs need to be granted at an exercise price that is equal to fair market value in order to be exempt from 409A. If you don't do that, then we fall under 409A. So the regulations for 409A actually provide that for a private company, the fair market value of the stock as a valuation date means a value determined by the reasonable application of a reasonable valuation method. And so it provides 3 valuation methods that are presumed reasonable, and you'll want to use one of these just because it'll confirm that the valuation we're using to price to grant the options or the SARs is at fair market value and therefore exempt from 409A. The 3 valuations methods, you may have heard or seen these, is The first one is a Section 409A valuation that you get from an independent appraiser, so long as that is no older than 12 months from the date of grant. And you'll want to make sure that nothing has occurred from when that valuation was received to the grant date that could have impacted the fair market value. The second one is a valuation formula acceptable under Section 83 with respect to non-lapse restrictions. So long as it's performed in a uniform manner for both compensatory and non-compensatory purposes, and used consistently, it can qualify as one of the safe harbor valuation methods. And then finally, there's the valuation of a liquid stock for a startup corporation. And so long as the company and the person performing the valuation has significant experience in such valuations, and there is a written report that takes into account the relevant factors under the regulations, this would count as one of the safe harbor valuation methods. Note that the company cannot be conducting its trade or business for longer than 10 years. So it's got to be in existence for less than 10 years and cannot have any tradable stock. We kind of alluded to this previously, but to the extent that we do not grant the stock options or SARs at fair market value, then these awards listed here will likely be subject to 409A. Want to point your attention to RSUs or deferred stock units. Maybe your directors or your executives want to defer the vesting or defer the settlement of their restricted stock units. Those are subject to 409A, so you want to make sure you get counsel involved to ensure that those are getting paid out on a compliant 409A payment date. Then dividend equivalents, they can't be paid upon the exercise of the stock option. Then payment on vesting or when paid to stockholders generally may be permissible.
The modifications with respect to 409A are again very similar to what they were with regard to the ISO rules, except there are some additional modifications that are allowed. Just like the ISO rules, modification results in a new grant, and what could happen is that new grant, if now the option is in the money, it's subject. It was exempt from 409A because it was granted at fair market value. You modify it, now it's in the money, and now you have a 409A problem. But acceptable changes that you can make that will not result in a modification and subjecting that option to 409A are an acceleration or delay of vesting, adding certain cashless exercise features, reducing or tolling the exercise window following termination, bringing it in, extending the exercise period, but only if you don't go beyond the original date of termination of the option. If it's a 7-year option and it was exercisable within 30 days following termination, you can extend it after that 7-year period, but not beyond that. Repricing to fair market value for underwater options, that's fine. Rollovers, substitutions in connection with a change control, that works. What doesn't work is any direct or indirect reduction in the exercise price or adding a deferral feature, some sort of feature where upon exercise you actually didn't receive the stock, you just received the right to receive the stock in the future. And the final sort of point to just hit as we're ending here, there's a lot of other arrangements other than equity that can get hit with 409A. As we said earlier, severance, annual bonuses, sale bonuses, retention plans. Severance is often deferred compensation. Issues to be on the lookout for to ensure that you're either compliant or exempt from 409A are good reason definitions. You don't want a good reason definition that sort of creates an easy trigger for somebody to walk out the door, because resignation, if you get paid on resignation, the way to really think about this, you get paid on resignation or retirement, that's going to create a 409A issue because a resignation or a retirement isn't a good kind of vesting event. Now, separation from service is a 409A compliant event. So severance can easily be designed to comply with 409A. You just want to make sure that what you have in place is either subject to 409A and compliant or actually exempt from 409A. Annual bonuses may or may not be subject to 409A. If it's truly discretionary, it's not deferred compensation because there's no legally binding right. But if there is a legally binding right, if you either pay it on a date certain, if the person has already resigned, or you pay it by March 15th of the next year, or you require that he be employed through the payment date, all of those will exempt annual bonuses from 409A. Sale bonuses and retention plan, it's really kind of the same concept. If you require payment, if you require employment through payment date, that's kind of always exempt under 409A, or you can pay them on a 409A compliant date. However, if you're dealing with like a sale bonus, it needs to be a 409A compliant change control. We're talking here like a sale of the company. A retention plan typically deals with a fixed date, and so that will typically that will comply with 409A. And if you have to be employed because it's a retention bonus on the date of payment, that will also be exempt from 409A. So any time where you've promised something to someone in 1 year, it can be paid in another year. You just need to be cognizant of 409A. All right. Sorry about going over a little bit, but thank you very much for your attendance. We didn't see any questions throughout, but obviously if you have things that you want to discuss or other issues, feel free to reach out to us. Our information is in the presentation. Thank you very much for coming. I appreciate it.
Thanks, everyone.